these banks are not just getting rid of divisions that were once profitable. Just, well, we don't want to do that business. They would love to do that business, but they know what's around the corner, and they're telling you there are risks everywhere in our fiscal system today.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, the times and dates are set, and we can start inviting the general public for some limited seating for the annual State of the Market address. Of course, there's a federal State of the Union address every year, and this is kind of our parallel event, State of the Market. This is you doing what I call a tour de force presentation of the year that was and the year to come, packed with charts, graphs, data, analysis. And David, you've upped the ante this year. Jeff Bush is going to join you, nationally known financial commentator Jeff Bush. How did that come about? Tell the folks about Jeff Bush.
Well, a lot of people are worried about this is a big transition, right? We have the pendulum swung pretty far this past election. So Jeb Bush is a nonpartisan guy out of D.C. who kind of has his finger on the pulse of what's going on. So we've invited him out to just speak on the likelihood of what policies will really get enacted based on, we have campaign promises and we're going to have reality, right? And how the makeup of Congress is, et cetera. And the likelihood of things being enacted, at least that were pushed on the campaign trail. And then I'm going to talk about what the reality of that is, after Jeff is done at this presentation exactly, and talking about what we see ahead for the economy and potentially for the markets.
Friday, February 21st, we're going to offer 2 sessions, 10 a.m. and 1 p.m. This is at the Durham Museum. If you come, you can also tour the museum for free. Now, clients, of course, are invited, and we are for the first time inviting the general public, but seating is limited. So you'll want to jump on this if you want to join us. 402-369-7777. 402-369-7777 to join us for the State of the Market address. All right, David, into the news we go. Here is the first headline. This is from CNBC. Budget deficit rose in December and is now 40% higher than it was a year ago. And you sent one of your little taglines. Oh, that's weird. You mean you can't just spend at will?
So for the fourth quarter or for the first quarter of the fiscal year. So our fiscal year starts in September every year, right? In October, the fourth quarter of the year is when our fiscal year is a
So the end of the calendar year is the beginning of the fiscal year.
Correct. And for that first quarter of our fiscal year, we overspent this year by $710 billion, more than just a year ago. If you go back 25 years ago, that was the budget, right? It was the whole budget. And we spent more, Chip, on interest payments in the last 12 months than we did on defense spend, or the only things bigger than that were defense spending, Social Security, and Medicare, right? And those will get eclipsed very quickly. Defense spending is going to be less than interest payments this fiscal year. And in 3 years, interest payments, the way we're going, will be the number one expense of our budget. This is unsustainable.
Well, it's already north of $1 trillion a year now, right? The interest payment on the debt, and that was supposed to come in a year or two, and we've already surged beyond that. So.
Yeah, and so we've seen the Federal Reserve trying to get the markets to take interest rates down, but all they can do is control short-term rates. They can't control the real rates of the market. And when I say the real rates, the 10-year Treasury is the most common one we want to watch because that's a barometer of what's going on. That affects mortgage payments, car loans, credit card rates, right? Because this is what banks are buying to backstop any obligations they have. And so the mortgage industry is in crisis mode right now simply because, a 30-year mortgage as of this morning was 7.36%. Now, some people are like, oh my gosh, I talk about it all the time. That's actually less than the 50-year average. I still remember refinancing at 7.5% the first time I did a refinance on our first home many years ago, and we were thrilled with that rate. But the reality is with prices of houses, the median house closing a $400,000 range, that payment makes a mortgage payment about $3,000 a month and that's not sustainable for the average American. So we do see a major correction coming in not only housing, but in our economy in general, because the bond market is telling you, Chip, listen, inflation is being sticky. We just had PPI and CPI come out this week, right? It shows inflation is still there. It's not under control. And then the bond market is really pushing rates higher because they're saying we're not going to take on more debt or you're going to have to pay us a higher rate for it. On top of that, I know I didn't send you the link here, but China has a $1.1 trillion trade surplus with the U.S. It's over $1 trillion now. In other words, we buy way more of their stuff than they buy of ours, right? But we know we get goods and services really cheap from China. People like paying less expensive for things. The problem is they used to take a percentage of that profits and buy our treasuries. They don't buy our treasuries anymore. I don't know if you realize this. China has been dumping treasuries for the last 24 months, is a net seller of treasuries, is not purchasing, and they're buying their own, which is driving their rates down. This is going to lead to a very major problem if our 10-year crosses over 5%, and we're not that far away now.
Well, since you brought up the topic of interest rates, David, let's jump to the, you sent me a story. This is also a CNBC headline. The Fed could be done cutting rates if Trump's tariffs are imminent. That's according to research and study by Bank of America. What is the relationship between tariffs and interest rates?
Well, unfortunately, you have, depending on where someone got schooled, these Keynesian economists that believe tariffs are inflationary. And there's zero data anywhere in the world to prove that's true. In fact, just the opposite happens. However, the meantime reaction is prices will adjust, but it is not actually inflationary on the production of the goods or services. It creates a balance. Now, this was written and before we had PPI and CPI, and the futures market only had about a 6% chance of a rate hike in 2025. Remember, we were talking about 7 cuts last year, or a rate cut, excuse me, only 6%. After PPI and CPI, we have about a 40% chance we're going to get 1 rate cut here in 2025. In other words, if inflation is under control, they might have room to bring it down. They are desperate to get rates down, as we said, because we have to refinance $7.6 trillion of already existing debt and another $2 trillion of new debt. So we're gonna float out over $9.5 trillion of bonds this year as a government, and we don't want to do it at 4.5% or 5%, right? And Janet Yellen did zero favors to the incoming administration by not following the normal curve of 2 years, 5 years, 10 years, 20 years, 30 years, et cetera. She refinanced everything on T-bills for the last 24 months, and that's what's created this massive problem. So again, this is going to create some problems. Now, creatively, what Trump's administration has already leaked out in the last 48 hours is they're going to do their tariffs in stages. In other words, instead of a 10% tariff on a country, 2%, get in line. Next month you didn't get in line. Now it's 4%, and they're going to walk the tariffs up gradually to actually
gradations. There'll be tiers of
correct.
Tariffs.
So, which is actually really smart because it will lower the rough edge, if you will, or the shock and awe of having a tariff placed on certain people, and it will give countries the opportunity to get in line or suggest something that gets it done. Bottom line, he's already got people coming to the table fighting to get to his inauguration, which Josh Cheadle, our Director of Advisory Service, is going to be attending the inauguration. I was blessed to be invited, but due to other circumstances, I can't attend. But his daughter will be singing, by the way, so we need to get Josh on the show here to talk about that. His daughter will be singing at the inauguration, so we're really excited for that. But anyway, it's we can't keep spending. It's just obvious, and the bond market is telling you that, regardless of the euphoria in the stock market after the CPI number this past week.
I like that Keynesian reference, John Maynard Keynes, the famous economist. How many other advisors? I
the famous wrong economist.
Well, exactly. I mean, he's considered gospel by some, but we've got to call him out now and then and point out that his doctrines are flawed. You mentioned Janet Yellen, and I know she's a short timer, and I don't want to pile on, but you did send me this, David. This is a headline from, this is also CNBC. Janet Yellen, COVID stimulus may have contributed a little bit to inflation. You think so? I also want to get your take. The story mentions her successor appears to be Scott Bessent, Trump's choice for Treasury Secretary. Your take on him?
So he's a billionaire in his own right. He worked for George Soros, but he worked for a couple other pretty big shops, and very, very well versed, understands economics, understands what moves the needle. He really understands the currency. That's what's really important here. He understands how the dollar is going to react based on the different policies that they may put in place, and that is why Trump chose him. And we have a very strong dollar right now. Once they kind of get in place in the tariffs, they're going to want a weaker dollar because that's going to help push our exports out, and that will help the economy here local. That'll help companies that export goods and services. So anyway, I'm positive on the choice. And again, this administration is making outside the box choices across the board of his cabinet, et cetera. And I always coach that coaches me. He says always give people the benefit of the doubt. I will give the benefit of the doubt that some of them that maybe don't have the skill set that you would think they would need taking some of these positions. But I think most Americans are fed up with the status quo, and so maybe new outside the box thinking is exactly what we need in some of these key cabinet choices.
Just quickly, one more story in this segment, David. And speaking of piling on, I don't know, maybe I get flagged for unsportsmanlike conduct for this, but we have to get the facts right, okay? The headline from Zero Hedge, now it's a little bit of hyperbole here. This is referring to job numbers, not everything on the planet. But the headline is, Biden lied about everything.
You don't say.
Philly Fed finds all jobs, quote unquote, created in the second quarter were fake. We got to be able to trust the numbers coming out of our government agencies. They can't keep coming back, 2 months, 4 months, 6 months later and revising. Oh, never mind. Those weren't the true numbers after all.
Over 1 million jobs last year. We lost. We didn't create a single job last year. Not one job was actually created. 1,086,000 full-time jobs were lost. We did create about 300,000 part-time jobs. And if you go back for the last 5 years, Chip, we have not created one full-time new American-born worker full-time job in this country, not one. We're negative on American-born workers creating full-time jobs, and that's coming to it's coming home to roost. All these numbers, and it was political. I hate to say it, but we used to, we've had speakers come to our events, et cetera, tell us you got to trust the data. I don't think so, because now we can't, and that's really, it makes it hard to do what we do.
I want Trump to succeed again economically as president, but I want the numbers to be real. And if there's
I don't want him. I don't want to go on the other way. Exactly. Let's just tell the truth.
Serve our clients too here at this retirement planning firm, and we need to know what the numbers are.
Telling the truth. What an amazing idea.
All right. Up next, the annual parade of classes, workshops, and events put on by Retire Smart is in full swing. The next one up is the ABCs of Medicare, and the presenter, financial advisor Miles Morrissey, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. The M in a SMART plan stands for medical and other health expenses. Medicare is right in the middle of that. Our class, called the ABCs of Medicare, is right around the corner, and the presenter joins us now. David, please welcome financial advisor Miles Morrissey.
Hey, thank you so much, Chip. Yeah, so in the studio for the first time is our Medicare extraordinaire man, Mr. Miles Morrissey, CFP. Thanks for taking time jumping in the studio.
Yeah, thanks for having me on.
So you've been on board for a while now here at Retire Smart, but you and your family and I go back a while. I've been friends with your dad for many, many years. You guys have been here in Nebraska basically your whole adult life, right?
Yep, for most of my life. And we had moved to California for about a year, then came back to Nebraska, moved up to Norfolk, Nebraska, and then now they're in Topeka, Kansas.
Yeah, no, your dad, did exit out of Elkhorn and went down to Kansas. And,
Yep.
I hope he's not a Jayhawk, but anyway.
No Jayhawks there, only Huskers.
So we have you teaching the class this year, the ABCs of Medicare, and your dad has actually worked in Medicare for decades, basically. Yep. So you are very well equipped when it comes to this. I mean, you probably talked about it at the breakfast, table, et cetera, with your dad before you went to school.
Yep. No, down at the dinner table, I remember, of course, as a kid, you don't really know about Medicare very much, but then all of a sudden you get into more details, and, he's obviously been a great resource for me moving forward in my career. So.
We're so, so glad we got you on board here. We did steal Miles away from a large national firm. We won't say which one, but I used to work there too. People can figure that one out. Anyway, all right. So we have a class coming up here. We just had a great round of classes on the tax and estate planning, our most popular classes. Fantastic turnout this past week. But for you, we have the ABCs of Medicare. When are those dates?
Yep. So that is Tuesday, January 21st at 6:30 p.m., and that is in the Midwest Learning Center here at Retire Smart.
Very good. You do need to register. You can call us at 402-369-7777 or just go on the events page on our website. So speaking of Medicare, we had a record number of people get hit with what we call IRMA penalties, the income-related penalties. They make too much money, according to the government. 8.4 million people, I believe, got those letters this past November. And those hikes are pretty steep this year, right?
They are. So they've been increasing more and more over the last few years. It's at 7.1% now on that lowest bracket for those IRMA penalties. And on the highest brackets, that's 7.3% annually. And so that's compounding over the last few years now. And unfortunately, it really is just a curse for those high income earners or those people that are really saving for retirement.
I think it's critical people understand that. So we got only a 2.4% increase in Social Security this year, but a 7% increase in Medicare, right? And it historically stays right around there, 6.48 to 7.5%, depending on B and D and SUPs, et cetera. But people don't realize it's compounding at twice the rate of inflation, which we just got some inflation reads this week on PPI and CPI, and inflation's still going. It's still there, still north of target. And so these are catastrophic in some households because it pinches the income every year. So what can people do to not hit those IRMA penalties? What can we do to prevent that?
So you really do have to plan for that ahead of time, because if you have a large, maybe traditional IRA bucket out there, you'll have required minimum distributions. And what those are is an annual amount you have to pull from those accounts, and it can push you into those higher Medicare brackets, those IRMA penalties.
I sometimes call it the success tax, right? You've been a successful saver, and you were told this myth you'll be in this lower tax bracket when you're retired, so you kept putting money in these deferred accounts, and it's just not reality for most people. So I think it's really important. We need income for retirement. But people need to realize there's what's called Medicaid or Medicare eligible income and non-eligible income. So there are sources of income you can draw, and it could include Social Security that will not trigger the IRMA penalties. But as you said, you have to understand how the rules work, how to lay out that income and pre-plan for it so that you can potentially have all the income you want, but never incur one of these penalties. And again, that takes planning, and you cover this in the class, I assume, right?
We do, yep. So we cover how to plan for that, how to maybe avoid that, and sometimes in some cases it actually makes sense to hit some of those Medicare brackets as well. But again, that is specific on your situation, and so that's something we can always plan for in our classes as well.
Well, I think that's really smart. Now, one of the things you sent an article to me prepping for this show this week that just talks about how the one thing is there's a lot of choices we have to make when it comes to Medicare, right? So there's four main parts, and you're kind of using three together, or you're using two together typically, right? So C and D are either going together on what I call the pay later side, or you're using A, B, and D together on the pay now side, if you will. And I love, we got some graphics up here. Choice overload, as you kind of call it, the article references, because people have no clue all the choices they're going to make and how it's going to affect them. And it's not just about, hey, what's the lowest premium, right? What is this going to cost me? It's what does it really cost you? Taxation, out-of-pocket expenses, and coverages in-network, out-of-network, et cetera. You're going to cover all that in the class, right?
Yeah, so a lot of those basics, and again, that's where we want to start at, is what are the basics of Medicare? What are the options available to you? Because having those choices and understanding what your options are will help guide you towards choosing the right path for your financial health and for your physical health as well. And I think merging those together is so important, again, to get that choice down.
Well, and I think what's critical too is when we step onto Medicare, it's very different the way most people have insurance administered their whole life through group plans, typically through work. So typically if there's two members of the household, one person is getting the plan and the spouse is covered. When you go into Medicare, it's individualized. So you could make very different choices, and you should, based on your particular medical coverage, what you need. And that's really important people understand. You can't just, we both chose, ABC Company's Medicare Advantage plan. No, that's probably not the right answer, right?
It is. And procrastination is a choice as well. And so if you hold off on this decision and say, well, you know what, I don't really want it to affect me, I'm just not going to make an option, that's not even an option available. You have to make a choice at this point. And so making sure you have proper guidance or researching is going to be super important to get those choices down.
What's really important too is, right, if they choose what I call the pay now side, you can make changes anytime you want because you're sticking with private carriers. If you go on the Medicare Advantage side, which is very popular because it's often advertised as zero premium or free, you can't switch unless we get to what's called open enrollment, right?
Mm-hmm. Yep, open enrollment periods, which are going to be starting at the beginning of the year. And then also when you turn age 65, you can actually choose up to 3 months before age 65 or 3 months after age 65 as well. And then we just actually got done with our annual election period, which started back in October through December. So there's a few options available to you, but again, it's making that choice and actually understanding your options.
And we just hit the deadline this week on January 15th. You could have you basically had a redo too. I didn't like my choice, but that's come and gone now, basically. So anyway, again, if you're out there, if you're 64 years old, have not yet started to get educated, this would be the class for you. Or if you're already 65 and want to know what your choices are for the coming years, I highly recommend you attend this class. We'll have this class. We do it, I think, once a quarter is the plan this year until we get into season. We do it a couple more times during the open enrollment season. But again, when will this class be?
So this will be Tuesday, January 21st at 6:30 p.m. And again, that's in the Midwest Learning Center here at Retire Smart.
All right, but you do have to call to register. All right, we are out of time for this segment. Miles, thank you so much for stopping into the studio.
Thank you so much for having me.
All right, Chip, what do we have next?
Up next, you have questions, David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, first question is about asset management. Can you explain the term rebalancing? I keep seeing it in retirement planning articles, but I don't understand what it is. Rebalancing, David.
Well, let's say you stand with your feet shoulder width apart and you lift your right foot up, and then you're going to fall over. You put your right foot down. Now you're rebalancing. No.
Oh, my goodness. He went there. All
right. No,
yeah.
Rebalancing in the most basic form, let's just say you had 60% of your assets in stocks and 40% in bonds. This is the old golden portfolios used to be called a 60-40 balance. What happens is those stocks are going to out-earn the bonds over time. So if you let them run for a year, you may now have 70% of your portfolio in stocks and only 30% in bonds. So you rebalance that. You sell some of the stocks and buy the bonds to get it back to a 60-40 percentage. In other words, you want to rebalance so that your risk allocation stays where it's supposed to be. And what happens, especially in retirement accounts, is people tend to forget to rebalance and they watch their stocks run, and it's great to see them go up, but they end up with way more risk than they're intending to take. And so rebalance is a critically important part of a portfolio management to help you stay diversified as your original allocation was set, but to lower the risk of a drawdown, and this is really important during retirement. Now, that's on the most basic. Inside the way an active manager like we manage accounts, we're going to have 5 or 6 different models, if you will, running, and we can rebalance each model based on different time horizons and allocations to get the overall return we're trying to get for our clients. And again, we're not for everybody, but we are focused mainly on retirees that have already acquired some decent assets, and they want us to give them a real rate of return consistently, beat taxation and beat inflation. But sometimes we have great markets. The last 2 years have been great examples of that. So we have to reshift some assets to de-risk the portfolio. So when we get a drawdown, they don't give up all the gains they've got. And this can help your money last significantly longer, at least according to historical data.
That is a stellar, well-reasoned, and nuanced answer. And yet I have to admit, my brain is still stuck on the hokey pokey after the way you started off on this. But let's move on. Actually, David, the next question also is about asset management. My dad has made me the beneficiary of his brokerage account, which is a sizable portfolio of stocks. I don't know much about how the portfolio is invested, but I'm mainly worried about the tax implications of this when he dies. Is there anything I should be preparing for now?
We always talk about the more conversation we have between generations that are going to be passing on, the easier the transition will be. So if you've already been told you're the beneficiary of the account, so that's a good start. So I would inquire to your dad, hey, do you mind if I know what's roughly the balance of this account so that I can prepare for my finances in the eventuality when this passes to me? Now, I have some good news for you. From what's called the taxation issue of the transfer of these assets. Unfortunately, when your father does pass away, you are going to get the benefit, at least under current law, of what's called a stepped up cost basis. So if you have, I'm just going to use a round number here, $1 million of stocks in this portfolio, even if your dad only spent $200,000 buying these stocks 20 years ago, now they're worth $1 million, you do not have to pay any capital gains on the gains your father got. You will get a cost basis at the date of his passing. Whatever the closing price is that day, that is now your cost basis, so that you'd be able to sell or liquidate those stocks with little or no capital gains taxation. Now, that's taxation from a capital gain standpoint. You will pay income tax on any dividends you receive in that portfolio once that date is passed. That's income to you. And then the other thing we have to focus in on is if you live here in Nebraska, there's going to be an inheritance tax, unfortunately. It's 1% on the first 100,000, and then it goes up. Or you get the first 100,000 without a tax, and then it's 1% on everything over that. And then we have to worry about the estate tax, which is probably not a problem unless it's a really big portfolio as we sit today. But again, you don't know what you don't know. This is why you would work with a qualified professional to simply help you understand what this is going to look like and how will this affect you. What year would we anticipate this? Because you may have other assets you're accumulating that could create additional taxation. We just had Miles on earlier talking about Irma. This is where people get caught. They have done okay, and we're managing that. And then, I inherited $800,000 from mom when she passed, and maybe she was 90, and all of a sudden you have more income. Now you're paying penalties for Medicare, et cetera. You don't know what you don't know. Pre-plan and see somebody. Doesn't have to be us, but I would see somebody immediately. Maybe it's just the advisor of your dad today.
That mantra of yours, you don't know what you don't know, is exactly what was running through my mind as you started to get into the possibilities here of how you can get blitzed and blindsided if you don't know the terrain. Boy, I'm also thinking of the first question. He may want to make sure that his father's portfolio is properly rebalanced as well. Risk levels that made sense 30-some years ago for an account may not make sense today.
Absolutely.
You're trying to conserve and protect at this point. All right, Let's get another question in here, David. This one is about debt. I'm 67 and plan to retire in 3 years. I owe $20,000 on my mortgage. I would like to retire debt-free. Should I use money from my 401k to pay off the mortgage?
No.
Well, especially if it's a low interest rate, right?
Absolutely. Most of the mortgages out there, over 70% of all mortgages out there are less than 3.75%. You can get more than that guaranteed on the money market right now. So I would absolutely not encourage you to do it. Now, that being said, peace of mind is real. I had a mortgage on one of our homes, and we own a few, but I had a 2.75% mortgage, and my wife just begged me to pay. And it was not a big mortgage for us. It was like, I think $92,000. I paid it off, and I took money that was earning me 4.1% guaranteed with no risk and no liquidity issues, and paid off a mortgage I was paying $275 because happy wife, happy life is a very real mantra in my life.
That's
However,
an important
fiscally,
calculation.
that was a decision that bends every bone in my body. So I would, from a fiduciary standpoint, recommend use the arbitrage in your favor. If the interest rate is in fact below what you can earn on guaranteed money, absolutely don't pay that off. Now, the second point of that question is, you said, should I take it from your 401k? Again, absolutely not, because that will be most likely a taxable event. If it's in the traditional side, you're going to pay income tax on that distribution. You're going to give up 20 to 30% of whatever you take out to pay off something that you can write the interest off. So in general, again, I don't know the whole situation, but probably it's a really, really bad idea. And again, this is why you work with somebody who can answer these questions and know all the specifics about everything else going on in your financial life. So I cannot stress this enough. It's a new year. If you've never made financial resolutions, get with it, get going, get your financial house in order, and work with a fiduciary-based independent advisor. It doesn't have to be our team here, but you should get with somebody that you feel confident and comfortable, has the expertise, the experience that you're looking for to answer these type of questions on a regular basis.
I find myself in conversations, David, with people who say, well, I'm smart. I'm not a dummy. I can figure out my finances. But the point is, there are so many moving parts, even to what seems like a simple proposition like this. It doesn't mean you're stupid, but if you don't know the terrain, again, you don't know what you don't know.
It's the ripple effect. You throw a stone in a lake, and it hit, and the ripples go out. You answer one question you don't understand. You create 16 or 18 other ripple effects that affect other decisions, and that's the way finances work. Medicare decisions, Social Security decisions, estate planning decisions, rebalancing decisions, equity decisions, income decisions, risk decisions. All these things have to be, thought about when you're, building a true holistic plan.
Well, even if you do decide to pay off that mortgage, well, now let's figure out how to do it in the most tax efficient way, so you don't leave any dollars on the table for Uncle Sam that you don't have to. So many considerations.
Well, maybe you could get that mortgage to identify as a student loan, and then it would be paid off. I don't know. Maybe we could try that.
Hey, speaking of mortgages, up next, homeowner mortgage defaults ignited the Great Recession. Should we be concerned about the current spike in commercial mortgage defaults? We look at that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, you were cranking out data and analysis this week, charts and graphs for the team. We're going to get through as many as we can in this final segment. And I want to take two things together because taken together, they kind of sent a chill down my spine. I thought, is this an echo of 2008? Now, we're not looking at home mortgages. We're looking at business mortgages, commercial mortgages. But one chart is about the spike in commercial mortgage defaults. And then you set another image of banks, real estate exposure, banks that may have some serious problems if these commercial mortgage defaults keep going the wrong direction. David, you have the floor.
So commercial real estate defaults are the highest they've ever been, higher than they were during the Great Recession. And these defaults are on commercial property, like the office building we work out of every day. And these are on mostly regional banks and some of the larger banks. Actually, the biggest exposure in the country to these is J.P. Morgan, who just reported, imagine that, stellar earnings this morning as of this recording, and their stock was up 2 or 3 percentage points. And I think people should get upset. Their earnings, Chip, had over $100 million of interest rate expense earnings. They earned additional interest over $100 million they weren't anticipating, and that was part of their rah-rah on their quarterly call. $91 million of that $100 million interest expense was you, Chip. The taxpayer paid that. How do you feel about that? You see, because the Federal Reserve is paying these banks to park money in the reserves. We're paying. They flipped from a Federal Reserve to an abundance Federal Reserve, and now we're paying these banks taxpayer money. The Federal Reserve is losing $200 billion a month. And you, the taxpayer, are paying for it. This is insanity. And yet the banks are out there, we got these awesome earnings. No, you don't. If you pull that away, they're in serious trouble. But back to the chart, the problem is when interest rates got this high just 2 years ago, we had banks fail. I think the first time we had major banks fail, we had 5 banks fail 2 years ago. Remember the SVB, the Silicon Valley Bank, first of all? And that's when the 10-year Treasury was up where it is now, north of 4.65. Well, we have over $300 billion worth of losses on the regional banks' balance sheets today. They're insolvent by any measure, and they're just playing with fire. So more to come if these interest rates keep going up. These banks will need to be bailed out, and guess who's going to bail them out, Chip?
Yeah, it's going to come out of my wallet eventually.
Absolutely.
As a taxpayer. I'm seeing, you mentioned regional banks, but I'm seeing J.P. Morgan, as you mentioned. I'm seeing Bank of America. I'm seeing Citigroup, Wells Fargo, Capital One.
Here's the thing, though. Citigroup, Bank of America, Wells Fargo, the Big
Four. We need some more.
The Big Four can't fail. They're too big to fail, literally. So the Big Four are going to gobble everybody else up. It's all the other ones that you have to worry about going away. And so I try to explain to people, the Big Four are so big, there's zero chance that they could fail because the government simply will not allow it. The problem is the 300 banks below those Big Four are all in serious trouble fiscally, and that is what I would be concerned about.
Oh, and the shock waves in the communities in which those banks operate if they were to fail.
Yeah, and I mean, we've seen it here. First National Bank, a great bank, right? Big presence, obviously, right here in the Midwest, based right here in Omaha. They've closed several branches. In fact, one of them's now a daycare out by where I live towards Gretna. They're closing branches. They completely gutted and got rid of their mortgage department. They are trimming and cutting costs everywhere to try to stay nimble to get through what they see coming. These banks are not just getting rid of divisions that were once profitable, we don't want to do that business. They would love to do that business, but they know what's around the corner, and they're telling you there are risks everywhere in our fiscal system today.
I want to remind radio listeners, David, as we go to the next chart, that these are available. We have a YouTube channel for Retire Smart, so you can see all of these charts and graphs. But in the meantime, you sent the team some information on the current disparity between market prices and earnings, and your contention is at some point they have to meet up. But what do we take this chart?
So the chart shows you
there's
a solid white line showing earnings growth basically of the market, right? So you take the S&P 500, the stocks and what they earn, and that's a nice steady eddy growth, right?
45-degree upward trajectory.
A little bit less than that, but yeah. And then you see the blue line, which goes 30. a little steeper, but much more volatile, right?
Yeah.
And that's the market prices itself. And you'll see what happens is it gets away from the earnings line as the market grows.
Almost double in some cases.
Yeah,
it looks
but
like.
what does it do? It pulls rolls back to the line, right? So everything reverts to the mean. Well, we're pretty far extended as we sit here today from where earnings are to the prices that we're paying. And I put this chart out that it's not to tell you to time. We can't time the market when the correction can happen, but the correction at some point happens. Either earnings have to quickly accelerate and grow faster to justify the prices, or the prices have to justify earnings and reset. Now, it will take a catalyst for that to happen. But again, if you're about to walk into retirement or just did in the last 3 to 5 years, you really don't have the time to have a redo, right? And the big correction you see on that chart, this chart goes back a ways. You see what happens in the dot-com bubble. You see what happened in 2008 when the markets retrace, and even during COVID. We've had 4 instances in the last 20 years of over a 35% retracement in prices when things get out of whack. Could you sustain the equity portion of your portfolio going backwards 35%? Just ask yourself that question. So maybe you want to have a risk analysis done if it's time to start relying on that portfolio for income that you're going to use for your retirement. That's what we're saying.
I don't know if people understand how crucial that is to our overall approach, that we want to mitigate damage when problems arise. That's part of...
And the data actually shows you actually get more income from a lower risk portfolio, not less. And without income, there is no retirement.
Because once the storm passes, you've got more money left.
Yes, you have more in the kitty, absolutely,
if you
to grow
mitigate
again.
the damage on the front end of it.
It's critical people understand these things.
All right. Next chart, David. In our world, FIA stands for Fixed Index Annuity. And you sent this chart with the accompanying message. Any FIA has outperformed the bond market for the last 10 years. And here's a chart that explains it. So what does that tell us, David?
Well, so oftentimes, like when I got in this business, we would use fixed income. These are bonds, whether it's government, corporate, et cetera, municipal bonds. Bonds produce income. You get paid a coupon or an interest payment every year. And the older you got, typically what we do is shift more of your assets into the fixed income arena to generate the income that you would live off of. And the older you get, the old adage was, if you're 70, we should only have 30% of your money in the growth stocks and then 70% in the fixed income bucket. Well, with interest rates, when they went to zero, we knew the warning sign was on there. So oftentimes what we'll recommend, and again, it's not in every situation, we may use a fixed indexed annuity that has zero fee or expense, by the way, to give us the bond portion of your portfolio, because it can earn income, it can earn upside based on the index it's tied to, but has zero risk of principal, and that's based on the full faith and credit of the issuing company. But if you would have owned the bond market, for instance, the last 5 years, the bond market, if you just bought what's called the AGG, the aggregate bond market, you'd be down north of 25%. Where a fixed index annuity, you're up. Maybe it's not equity money you're up, but you're up a few percentage points.
I thought the bond, it was like the tortoise and the hare. The bond is the tortoise, but the bond is safe. The bond, you're never going to lose on a bond, I thought.
Well, see, that's what people got in their head, because we went on a 40-year bond bull market. When interest rates went to 20%, the last time inflation got out of control back in the early 80s, for 40 years, interest rates did nothing but slowly come down. So that benefited mortgage companies, because you would refinance about every 2 years, another lower rate. So it was beneficial to the economy that way. And you got paid on those bonds, because when rates came down, your bond price went up. So bonds were amazing return vehicles. Once interest rates, after the 2008 collapse, interest rates went to zero, bonds have not performed in the last decade at all. Now, it doesn't mean they won't perform again now that they're off the floor. Now we have to wait and see what kind of crisis comes. Is the Fed going to rip them down to zero again, make bonds useless again? Or are we going to maintain a normalized rate environment where we can start to utilize fixed income traditionally? Again, I don't know the answer to that, but I can tell you what we do is we make the best choice for our clients at the time they're walking into retirement. Find the best vehicle to give them the income that they need. And that's what's critical, because if you don't have consistent income and risk management, you're probably not going to have a very successful or happy retirement.
Next chart, David. And if I understand this correctly, Abercrombie and Finch Company put out a bullish growth estimate, robust, and yet the stock shares fell by 20%. Is that what the data is telling us?
Yeah, and so I sent this one just out as a one-off, but this isn't the only one. We saw a couple other companies have the same reaction here. And what I'm telling you is that this is telling you they gave decent earnings, and they actually tried to forecast an increase in sales. What they did not increase was their profitability, Chip, and that's what we care about, the bottom line. The earnings we just talked about. So even they're going to sell more, their cost is up. Labor cost is up, the goods and services cost, the inflation on the materials to make the things they sell. And so the stock got whacked on forward guidance of profitability. In other words, we pay for earnings. So at some point, this is just one example across all these industries, if we have to start resetting our expectations for lower earnings, that's when the prices of the market will have to correct. And again, I'm not making any predictions. I'm simply trying to get people to pay attention because we're as extended as we've ever been. According to the Buffett indicator, we're at 206%. And so as Buffett said, anytime it's over 200%, it's a high-risk environment. In other words, that's the Wilshire 5000, the value of the Wilshire 5,000 publicly traded stocks. You compare that to GDP, and we're at 205%. If it's below GDP, you buy stocks. If above it, you have caution. If it's 200% above it, it's really be careful. That's what happens there.
David, with this next chart, you said if markets break through to the downside, we may go down quickly to 5,500 area or worse on the S&P. Well, that got my attention. But this chart deals with something with which I am not familiar, the E-mini future. What is an E-mini future? And therefore, what does this chart tell us?
So people that are day traders trade the futures market more than they do the actual market. And futures market is simply a contract on the future price of something. And so the futures market trades basically before and after the marketplace, and it kind of gives you an idea where the market's going to open each day and why we pay attention to this, why I watch this every morning and late at night. People would, if they see the setup I have at home to watch this stuff, it just tells me where things are going, right? And it helps to understand. But there's some significant lines in the sand, resistance levels, trend lines that we pay attention to. And exactly 5,800, the S&P went below that earlier this week, then rallied after the inflation data. That was kind of a line in the sand that we've actually flipped the switch. The S&P is now, the bullish trend is stopped. So now we're rolling over, and are we going to start a bearish trend? I don't know. But when we break support, we usually go to the next line of support. Now it's about 5,500 on the S&P. So that would be about a 300-point drop in the S&P. Well, that would be painful. That'd be 8 or 9% down. We're already down 4 or 5% off the high. So now you're into what we call correction territory when we go past 10%. When we get into bear markets, that's 20%. Again, we're just giving you information so you understand the risks, et cetera, that we're facing in the marketplace.
We'll keep an eye on all of these indicators going forward, but that'll do it for this week. Please visit our events page at retiresmartomaha.com to see everything we currently offer. If you want to catch Miles Morrissey next week, or if you want to join us for the State of the Market event, retiresmartomaha.com. There's no charge, no obligation for these events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, stay warm. It's going to be a little chilly this week. God bless. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.